Will Powell cut rates in 2024? We'll talk about that. How will I trade it? I did it today. Stick around and I'll show you how. Let's jump into what might be happening with Powell. Where is my news here? I got a Forbes article on Jerome Powell. And it said the Fed funds rate, let me zoom this in a bit. The Fed funds rate is expected to decline by the end of 2024, but not much and largely later in the year. That's the current expectation of both policymakers and markets, even though the Federal Reserve could still raise rates one more time in 2023. And this is going back, this article is in October. Okay, this is a little dated, but it's still legit. The markets remain somewhat ahead of the Fed in the magnitude of the potential 2024 rate cuts. Okay. It is talking about there's a 1% decline, maybe by the end of 2024. That's what the markets were expecting. Now, the Gorilla has a little bit deeper information on that. And he has given us some information inside the private Algo Factory lab as to what he thinks is going to happen with the Fed funds rate. And let me explain to you, first of all, the way this works is that the cheaper money is, the better things go. Okay, so when the interest rate is low, then it's easy to borrow money. And pretty much all of your big money going into like stocks and stuff like that, that's going to be, I'm guessing 95% borrowed money. I'm not sure what the percentage is, but there's a huge amount of money at the institutional level that's going to be borrowed. A lot of it's going to come from 401k contributions. Maybe not 95%. I don't really know the number, but I will tell you that stocks are vastly, like especially blue chip, large companies, Apple, so on and so forth, a lot of those go up based on the ability to borrow money against your corporate bonds. Apple is one of the most leveraged companies out there. What they've done is they issue corporate bonds. And then last I looked, and this was like a year or two ago, Apple had over $1 trillion, I think, if I'm not mistaken. I'd have to look that up. It's a massive number, but whatever the number is, they have borrowed so much money to prop up their stock price. And when your stock price is propped up over years and years of borrowed money, it is severely affected by the interest rates. Okay, so when they're talking about interest rates being cut, what that's going to mean is that it's going to be cheaper for large companies to borrow money to prop up their stock, right? And it's going to be cheaper for large players to borrow money to buy stocks. So, for example, the ultra rich people, they don't necessarily liquidate their stocks. They will, but a lot of times they simply put their stocks and their equities and the rest of their assets up as collateral for what ends up being very, very cheap loans. And then they use that to buy more assets, right? They just leverage their whole book. Now, when the market goes down, that's a problem because people's collateral goes down and their ability to borrow goes down, and then everything stops. It's like putting a magnifying glass on the whole problem. So, when the money gets cheaper, it's easier to borrow, everything goes up, and that's like putting, turbo boosters on the market because everything works on debt, right, in the end. And of course, there's the rest of us buying money with cash or buying stocks if you buy stocks with cash and all that. And that's, that gets boosted too, because when the big money in the borrowing goes into play and the stock prices go up, of course, everybody else is like, hey, I want to get in. And then it's a positive feedback loop. So this debt kind of positive negative feedback loop that is basically magnifying everything. That's how the whole system works. And right now they're talking about Fed projections. And I'm going to go back to the article here. The Fed's own projections is shared in the summary of economic projections on September 20th. See short-term rates around 5% at the end of 2024. As such, most officials see rates declining, but on a slower trajectory than fixed income markets currently project. Okay, so a lot of officials actually are on the conservative side when it comes to the rates dropping. Okay, they're even talking about a final rate increase, but we knew that didn't happen, right? There was a Fed pause. And by the way, this article is very interesting because up until December, or up until the December Fed, Powell was talking about like, hey, we're not ready to start talking about cutting rates. We're not ready for it. And the whole market was like this article, which was kind of more of a hawkish look, like, hey, we might even see a rate hike in December. Well, what ended up happening was right up until the hike, like 2 weeks before the hike, Chairman Powell was talking and saying, hey, it's not time to talk about cutting yet. And then all of a sudden, during the FOMC a couple weeks ago. Powell's like, "Hey, we need to start talking about cutting," and the market went ape. The market really just everybody aped in. If you want to say it went ape, I mean, it went crazy. Gold went up, like stocks went up, everything kind of went up. Now there was a point there, and we'll take a look at the S&P 500 where everything kind of puked out there towards the end of the year, just like last week. However, it did kind of get held up, so we'll look at that. Let's look at a dot plot here. Let's look at the Fed dot plot. I'm going to sort here on the articles for past week. 12/22, the Fed dot plots. And this is a really good article, I can tell, because, I mean, Forbes is pretty decent, but this cautionary tale for interest rate fortune tellers, right? And this is probably going to have to do with what I just talked about, how everybody was talking about, the possibility of like another hike, and they're not going to cut rates very much. And now here we have as of December 22nd, just a few days ago, what does 2024 have in store for us on the interest rate front? Will interest rates stay elevated or decline? The consensus is the rates will decline. However, investors should be cautious about relying on such forecasts because predicting interest rates is fraught with difficulty, which we just saw. We saw everything like the worm turn last minute in December, right? Powell was not talking about cutting, and then all of a sudden he's talking about cutting, right? And there's probably some political pressure behind him. You got an election year. They want to have the market go up, things like that. It says here, 4 times a year, the Fed publishes the predictions of the 19 participants on its Federal Open Market Committee, FOMC, right? These predictions are commonly displayed via a dot plot, where each dot represents an FOMC participant prediction of the Fed funds rate at the end of each calendar year. So let's actually skip, if we can find the dot plot. So what they're looking at here, this is an older dot plot. And what they're doing is all of the different individuals who make the decisions and have the voting on what happens with the interest rate, they kind of place that in here in like a predictive kind of sort of way. Okay. So 2023 Fed funds rate, target rate 2023, is here now. What they're looking at is raising the target rate, right? And look, the Fed funds rate ended much higher than the target rates. So you can see the FOMC forecast year-end Fed funds rate at the end of the year. These are the forecasts, and then this is the reality, the yellow dot. So now we have a forecast that is much higher than these prior years. But look at these prior years. The actual reality was much, much higher than the forecast in the dot plot. And I know a lot of people looking at dot plots and they're all like, oh, the Fed expects this, the Fed expects that. Well, look how far from expectation this is, right? So, and this article is really good. Again, it's a cautionary tale. It's don't rely on these fortune tellers. Don't rely on the dot plots. Don't rely on all this stuff because policy can change really quick. And I guarantee you, I can all but guarantee you, the Fed's not just like making decisions based on data. I mean, they are. I'm sure they are. But I can also tell you there's political pressure behind the scene. There's the BIS telling Powell what to do. I mean, I guarantee you everybody talks, but in the end, someone probably walks up and says, hey, this is what you're going to do, right? And this is why we end up with what we end up with. And plus, 2021 was a great year. Like that one was as expected. Everything was going up. They had pumped a bunch of money into the market, but, you started to see the inflation problem, right? So, and the inflation was, that might be the reason why this all happened. But long story short, this is what happened versus what was supposed to happen. Yellow dot reality, blue dot forecast. So how far different will the blue dots be to the yellow? That's going to be the major question. And then I just explained all of that. So let's see here. Okay, so yeah, remember they were talking about transitory inflation. So Powell's talking about how, yes, inflation is transitory, it's going to go away. And they stopped talking about that. They're like, okay, we're just going to hike rates. Like we have sticky inflation, right? That's kind of the term that was being used. It's sticky. We got to unstick it, right? So dot plots here, they're kind of projecting rates around this kind of 2.25 to 3.75. And who knows, the actual reality of the situation might come closer to where the projection is. It might be that as time goes on, and more data comes in, all the members of the Fed are able to kind of have their estimates be closer to reality. The market is a living, breathing thing, right? So you can't just, estimations are estimations. That's how that works. And then, so anyway, these are the dot plots. That's what that is. And the whole thing is that the whole point here is that we do expect like some cutting next year, but we cannot rely too much on the estimates of these people. All right, cool. So we have enough time to take a brief look at the trade I'm in. And of course, we're getting a pullback, which is lovely. So that pullback, we'll see what happens with it. If I can get a nice pullback, and I did enter a pretty small trade here. So if I could get a nice pullback, let's fix that and delete that. I will go ahead and enter a second entry on this. So, and I'm expecting price to kind of pull maybe this, right? So if that's the case, and it may not go this high, that's fine, but I think it will. I mean, my target's up there. On a high time frame, this is what it looks like. So if I can get a nice pullback, I may enter. It'll probably be the same size trade, but just with a much higher risk to reward on that. So, we'll see. We'll see in the market catches. It'll probably. I'm imagining it'll look something like one of these pullbacks here, but it might not go that far. I mean, if it goes as deep as these or a lot deeper, then my thesis on the breakout is wrong. It means that this wasn't a breakout. But I can tell you chart-wise, it's a breakout. It's a breakout of a breakout. You had this higher time frame kind of move here where you're going back to earlier in the month. And again, how does this relate to Powell and all that? Well, this is traded against the dollar, right? So right now, all the talk is that we're going to see cuts in the dollar. Well, if the dollar is going to get cut, then all assets traded against the dollar are going to see a boost. Now, if the asset itself has some kind of fundamental issues, the asset will not go up. But the average asset that does not have fundamental issues, or at least is nominally okay, those assets should continue to rise. And the euro against the dollar is a perfect example. It's a very liquid pair. A lot of people don't like to trade it because of some of the liquidity grabs that happen. But if you know how to play those, you're good, which is exactly what I've done here. I took a smaller trade, right? And now price may go down and grab that liquidity. But as the cuts next year talk is going to keep happening, as Powell keeps talking about cutting rates, you're probably going to see a lot of these, like you get this pullback and then a monster push up afterwards. And that's pretty much what I think is going to happen. And if price doesn't go that far down right now, if it just is kind of playing around and only maybe does something like this, I'm not going to put any more money on this. Probably not. Now, what I may do with this trade is I may simply push up, pull back a little bit. And if it does do something like this, even if it's like a little bit higher up like this, something like that, then I may end up, depending on what the charts say at that time, I got to read the charts at the time, but I may end up taking a nice tight trade in this area with the same target. It may be a smaller trade adding on, but it might look something like this, something like that. So it's just, again, it's going to depend on price action. Already the pullback that we're seeing right now is almost completely eliminated. If you look here, see, there was a nice pullback, pulled back pretty hard. And then now it's just like already back up to entry. So really, now I'm in profit. I mean, this is a very, very bullish market. So I think a lot of the Fed rate cut talk is just bullish, bullish for stuff. Like, for example, this morning I got into a short thinking that this was going to go down. And as it did, it went against me and it popped up really hard and I realized what was going on. So I got out of that and then I entered along and got my money back and then some, because that's the way my algo works. I can actually play that. I can go, if my algo is so strong that if it goes against me in that manner, I know that if I go against it, then I'm good to go, right? So technically, I could take a wacky trade right now. I'd have to look at the algos, but it looks like I could enter here with this pretty tight stop below this pullback. That's a possibility because it looks like it's about to rage up. So, for those who are in the kind of risk loving, group, that's one way to go. Just throw a small trade up there like that with a 4.7 to 1 risk to reward ratio. Beautiful trade if that's what you want to do. Again, I'm not, getting no investment advice here, folks. It's all just charting, right? So it's all just talking about charts, but that is it. That's what I'm looking at from a trade. And again, that's going to affect things like Bitcoin as well. Okay, so here we are a couple hours later, not even that, and this is where I exited right here. Nice, beautiful trade, beautiful profit, and price actually kept going up a tad. But whenever I see a big candle like that, I tend to take profit because big candles like that are often followed by moves down or in the other direction. So I did that. That's one of my rules. Also, I have the current price action right here. I have the arrow where I took profit, and you can see prices kind of just stopped going up. It might head down, but it might not go that far. The market is still pretty bullish for the euro, or I should say bearish against the dollar. But still, this was a beautiful trade, and it looks like I took profit at a pretty good time because price started to stall out right after that. All right. All right, thanks for stopping by. We hope you enjoyed the show. Come visit us over at our website. You see it on the screen right there. There's also YouTube, Twitter, aka X, TikTok, Rumble. You can zap that QR code or take you straight to the website. I am very active over on Twitter/X. Also, we are live. That's Monday through Friday, 8:30 a.m. EST, right up to 9 a.m. EST. Come stop by, talk to us on YouTube, ask us questions. We're happy to help you out for free. Hope to see you there.